There's a window at the Federal Reserve that almost nobody talks about. It's open 24 hours a day. Any bank can walk up to it, hand over certain assets, and walk away with cash. No questions asked, no public disclosure required. In the last 2 years, banks have used this window to borrow over $3 trillion. And the strangest part? Most of them didn't need to. This isn't about a bailout. It's not a crisis facility. It's something far more subtle and far more structural. It's called the discount window, and it's been around for over a century. But something has fundamentally changed in how banks are using it. Silicon Valley Bank collapsed in March 2023. Within 48 hours, discount window lending spiked from $5 billion to $153 billion. That made sense. Banks were panicking. Liquidity dried up. The Fed stepped in. But here's what didn't make sense. Months after the panic ended, the borrowing didn't stop. It just went underground. Banks kept coming back, quietly, consistently, at volumes that had nothing to do with distress and everything to do with arbitrage. What started as an emergency exit became a profit center. And the mechanics of why that happened reveal something uncomfortable about how modern banking actually works versus how we think it works. Let's rewind. The discount window was designed as a safety valve. If a bank runs short on cash, maybe because depositors withdraw too much too fast, it can borrow from the Fed using its assets as collateral. Government bonds, mortgage-backed securities, corporate loans, you name it. The Fed doesn't give you the full value of those assets. They apply a haircut. A treasury bond might get you 98 cents on the dollar. A riskier asset, maybe 85 cents. The idea is simple. Borrow against what you own, pay it back later with interest, and nobody needs to know you were ever in trouble. For most of the 2000s, banks avoided this window like it was radioactive. Borrowing from the Fed carried a stigma. It signaled weakness. If word got out, depositors might flee. Investors might dump your stock. So banks would rather borrow from each other, even at higher rates, than touch the discount window. Then 2023 happened. The stigma evaporated. When everyone's borrowing, no one looks weak. But something else happened too. Interest rates shot up, fast. The Fed raised rates from near zero to over 5% in less than 18 months. And that created a strange new math. Banks were suddenly holding trillions of dollars in bonds they'd bought years earlier when rates were low. Those bonds were now worth much less on the open market. If a bank needed cash, selling those bonds meant locking in massive losses. But the discount window doesn't care what your bonds are worth on the market. It cares what they're worth at maturity. A bond you bought for $100 that's now worth $85 in the market, the Fed will still lend you $98 against it. That's not a safety valve. That's a subsidy. Here's where it gets weird. Banks started borrowing from the discount window not because they needed emergency cash, but because it was cheaper than the alternatives. Let's say you're a regional bank. You've got $1 billion in treasury bonds that have lost value because rates went up. You need liquidity, but you don't want to sell those bonds and realize the loss. So you go to the discount window, you borrow $980 million against them. The Fed charges you, let's say, 5.5% interest. Now you take that $980 million and you do one of two things. You either lend it out at a higher rate, maybe 6.5% on commercial loans, or, and this is the truly absurd part, you deposit it right back at the Fed in something called the reverse repo facility, where the Fed pays you 5.3%. You just turned an underwater asset into a revenue stream. Some banks went further. They used discount window loans to avoid selling securities at a loss, preserving their capital ratios and keeping regulators happy. Others used it to smooth out lumpy balance sheets at quarter end, so their financial statements looked cleaner than they were. The Fed didn't stop this. They couldn't, really. The discount window is designed to be a no-questions-asked facility. Preventing abuse would require exactly the kind of scrutiny that defeats its purpose. But the result is banks are now borrowing from the central bank not to survive a crisis, but to optimize their balance sheets in a high-rate environment. And the costs of that optimization, the interest the Fed forgoes, the moral hazard it creates, those costs are socialized. The profits are not. Publicly, banks talk about resilience. stress tests, capital buffers, lessons learned from 2008. The message is always the same. We're safer now, more responsible, better regulated, better. And in some ways, that's true. Banks do hold more capital than they did before the financial crisis. They are more transparent, at least on paper. But the discount window exposes the gap between the story and the structure. Because what it shows is that when the math makes sense, banks will arbitrage anything, including the lender of last resort. The Fed knows this. In internal documents, officials have noted the shift in discount window usage. Some have quietly suggested reforms, tighter collateral standards, higher penalty rates, more transparency about who's borrowing and why. None of those reforms have been implemented. Part of the reason is political. The discount window exists to prevent bank runs. Making it less attractive risks making it less effective in a real crisis. If banks think twice before borrowing during a panic because they're worried about stigma or cost, people could lose their savings. But the other part is philosophical. The Fed has spent decades insisting that banks should use the discount window without fear, that it's a normal part of monetary plumbing, not a mark of failure. Punishing banks for using it now would be admitting that the facility has been captured by behavior it was never designed to encourage. So instead, we get a strange equilibrium. Banks borrow, the Fed lends, the numbers keep growing, and everyone pretends this is fine. Zoom out for a second. What does it mean when the central bank becomes not just a lender of last resort, but a lender of first resort? It means the line between monetary policy and fiscal policy is blurring. The Fed is effectively subsidizing bank profits in a way that's invisible to most people and unaccountable to almost everyone. There's no congressional authorization for this, no budget line item. It just happens because the mechanics allow it. It also means risk is being mispriced. If banks can offload their underwater assets to the Fed without consequence, they have less incentive to manage interest rate risk carefully. They can take bigger duration mismatches, chase higher yields, and know that if rates move against them, there's a backstop. That's fine until it's not. The discount window can provide liquidity, but it can't create solvency. If a bank has genuinely bad assets, loans that won't be repaid, businesses that are failing, borrowing from the Fed just delays the reckoning. It doesn't prevent it. And here's the uncomfortable part. We won't know which banks are using the window as a lifeline and which are using it as a profit center until something breaks. The Fed doesn't disclose borrower names. It publishes aggregate data with a lag. By the time the public finds out a specific bank was leaning heavily on discount window loans, it's usually because that bank is already in trouble. Transparency would help. So would pricing the facility more carefully, charging rates that truly reflect the penalty nature of last resort lending. But both of those solutions run headlong into the Fed's other goal, which is making sure banks actually use the window when they need it. It's a trap of the Fed's own making. So here we are. A facility designed for emergencies has become a tool for optimization. A lender of last resort has become a shadow subsidy. And the banks that spent the last 15 years telling us they'd learned their lesson are back to doing what banks always do, finding the edge, exploiting the gap, and passing the risk to someone else. The discount window will stay open, the borrowing will continue, and the next time someone asks whether our banking system is as safe as regulators claim, remember this. The math only works because the Fed is quietly making it work, and we're all assuming that can last forever.